Thank you, Mr. Chairman, for your kind introduction. And thank you all for the kind invitation to talk about exploration trends at the RIU Explorers Conference, where it is clearly relevant. In the words of George Harrison, it's been a long, cold, lonely winter since the peak exploration in 2012. I guess the question that has yet to be definitively answered now is whether or not here comes the sun. My talk will concentrate on macroeconomic indicators that have an influence on the mining and exploration business. Comments have come from my experience in the mining business in roles from both industry and consultancy over approximately a 25 to 30 year period. As part of CSA Global, we have mineral projects all over the world at all stages, so we get to see at firsthand the impact of changing trends. All cycles are subject to peaks and troughs resultant from supply and demand and other factors, and the mineral industry is no exception. This graph comparing metals prices, in this case the S&L index metal price, with market capitalization of publicly listed companies makes this point. From the global financial crisis in 2008, we saw steady incline as a result of increasing metal prices in market capitalization. Since 2012, however, we've seen a steady decline in market capitalization as weakening markets and commodity prices have fallen. Recent increases in commodity prices suggest return to recovery. Another way of looking at cycles is a roller coaster ride of volatility. Over a 10-year period, we've seen the boom of a lifetime, which ended in 2008, beg your pardon, with global financial crisis. From 2010, on the back of stimulus-led investment, we saw a short-term return to investment in exploration through 2012, followed by subsequent declining interest. Here we are in 2017 with signs of recovery. Of course, exploration budgets in the industry are strongly constrained by metal prices. This graph comparing, again, the index metal price against exploration budgets makes this point. From a low of $2 billion in 2002, we saw steady gains through 2008, where a peak of $14 billion was spent prior to the GFC. The GFC, of course, wiped about 40% off exploration budgets before we saw a short-term return to spending, with peak budgets at $20 billion in 2012. Subsequently, you had year-on-year declines through 2016, with last year seeing approximately $7 billion spent globally on exploration projects. Of course, access to financings has a huge impact on companies' ability to carry out exploration, particularly in the junior and mid-tier sectors. This graph of financing clearly closely follows the S&L Metals Index price again. However, noting that 2016, the increase in financing has had little impact on our budgets, as I said, with overall global budgets decreasing to $6.89 billion last year. Comparing that same trend of financings for exploration companies, we look at success in the exploration business, in this case, on the basis of announcements, public announcements from listed companies. While the two track relatively similar patterns, clearly there's less volatility in the announcements. I suggest this is a shift out of risk into more advanced projects. On the other hand, whilst success continues through this period, reaction from the market in the form of financings is very limited, particularly through 2013 to 2015. Now let's take a brief look at commodity prices on a small selection of commodities. While metal prices have continued to grow in 2016, sentiment has improved. Copper and zinc have had material gains, particularly late in 2016, whilst gold and zinc have shown longer-term gains with greater volatility. Overall, the sentiment on metal prices is improving, and metals such as iron are strongly improving. I guess one of the things that is commonly noted in this is supply concerns. Perhaps this is not surprising given the lack of exploration activity we've seen over the last few years. So let's look at what exploration companies are targeting globally. Of the $7 billion that SNL records for having been expended on exploration last year, nearly half of that has gone into gold exploration, and that number continues to increase. Between base metals and gold, we account for nearly 3/4 of the global exploration budget. Decline in steel mineral exploration, uranium and coal projects continues, while strong demand for battery and specialty metals continues to climb. Looking at similar trends in Australia, we see that gold continues to surge forward with quarter-on-quarter from 2014 expenditure almost doubling since 2014. In the meantime, base metal exploration costs have remained, or expenditure have remained relatively static during this period, with coal and uranium also declining. Whilst iron ore exploration trends are declining, it still continues to make up a substantial portion of all expenditure in Australia. Battery metals and specialty metals demand continues to climb. I guess the question is whether that will continue to be sustainable. Let's look at who's exploring by type of company. As equity markets make access to financing more difficult, the ability for mining companies to carry out exploration and mining activities decreases clearly. The result is that junior miners have gone into survival mode with strong decreases in expenditure. In the same period, major companies have also decreased their expenditure. But on a percentage basis have now overtaken the juniors in total expenditure. Looking at what type of exploration is being carried on at the moment, not surprisingly, with decreased access to capital, we see a shift away from risk. There's been a strong decline in grassroots exploration, with a shift to brownfields exploration making up a significant portion of total expenditure. Ongoing commitment to late-stage or low-risk projects is making up the balance and has remained relatively steady. Comparing similar trends for Australia, this graph provided by Mato Advisory based on ABS data shows similar trends. The dark line with red dots is for existing project exploration. On a trend basis, this has remained relatively static over recent times. In comparison, the less prominent line beneath it shows an almost a drop of half in expenditure for new mine exploration in Australia. So where in the world are we expending our money? This graph from SNL Mining shows a relatively clear picture. Countries with high mineral potential and adjudged low sovereign risk are receiving the lion's share of exploration budgets, with Canada and Australia once again topping the list. On a regional basis, Latin America is also receiving a large chunk of funding. Whilst the United States budgets continue to decline, overall, the Americas receive better than half of total global exploration budgets. When we look at the top 10 countries by exploration budgets, the picture remains the same. At left, we're looking at budgets or countries at which the top 20 companies by exploration budgets are spending their money, topped by Rio Tinto and AngloGold. Again, we see a shift away from risk with a dominance in the Americas. When all budgets for all listed companies are taken into account, we see a much more diverse set of countries in the top 10, with countries such as the Congo considered higher risk coming into that list. Looking at the spatial distribution of exploration expenditure, we see that a significant percentage of budgets are going into countries, perhaps in Africa, where they are considered higher risk. I suggest that the attraction of low-hanging fruit is attracting investment, whilst the majors are taking a wait-and-see approach. As we go into go exploring under deeper cover and into more difficult and diverse jurisdictions, exploration costs are increasing. Some data is suggesting costs have doubled since 2008. Advances in technology have to have a positive impact on that. Geophysics and geochemistry improvements are helping explorers make better decisions at early stage exploration processes, and innovations and technologies are helping to mitigate cost structures and bring exploration decision-making into a real-time space. So in summary, let me summarize our view on global exploration trends. Short-term market volatility has had a massive impact on the mineral exploration sector, both in terms of level of activity and effectiveness. Exploration activity and focus mirrors trends in markets for metals and minerals. Regional trends highlight mineral investment attractiveness based on mineral potential and geopolitical risks. Factors such as tenure, land access, and mining and investment have an impact here. Discovery costs are rising as we explore in remote and logistically difficult geography, search undercover and at depth, and have higher compliance and overhead costs. Rates of discovery are falling as more effort is placed on brownfield exploration for quick success near existing mines. With falling greenfields exploration, we are reduced to the global pipeline of projects which are needed for future discoveries and global mineral supply. We must be smarter in our exploration efforts, integrate science and technology, and increase our exploration search space. Use all of the data to make our best decisions if we're to continue to have success. In parting, it's clear that we need access to greater funding to ensure a future of exploration business. This data, sourced from the ASX, shows the level of funding over the most recent years on the basis of successful resource IPOs. Between 2014 and 2016, we see a general low number of IPOs with an average of 8 each year. The number for 2017, just for the first month, is 6, a similar number for each of the full years previously. Estimating this forward, perhaps 2017 will see an order of magnitude improvement in our funding going into exploration. Perhaps the sun really is coming up again, and long may it shine. Thank you.